Sam Bankman-Fried was on the cover of Forbes. He testified before Congress. He was worth $26 billion. And the whole time he was stealing his customers' money and gambling it through a hedge fund run by his ex-girlfriend from a penthouse in the Bahamas. This is not an exaggeration. This is what actually happened.
By early 2022, FTX had achieved a $32 billion valuation. They aggressively inserted themselves into the cultural mainstream, using expensive celebrity endorsements like Tom Brady to project an image of absolute institutional safety. At the center was Sam Bankman-Fried, the math nerd who seemed indifferent to his own wealth. He championed effective altruism, telling the world his only goal was to get as rich as possible so he could donate every cent to charity. He turned this persona into political capital. He frequently appeared in Washington, testifying before Congress and helping lawmakers draft federal policy to regulate the crypto market. These appearances were backed by roughly $38 million in political donations. It was a massive financial commitment to buy the trust of politicians and keep their attention away from his internal operations. The public saw a compliant, transparent leader. But the private reality was an $8 billion theft that eventually landed him a 25-year federal prison sentence. The cargo shorts and philanthropic pledges functioned as a manufactured shield. This character was designed to deflect scrutiny from strict government regulators, from large private investors, and the mainstream media, while a criminal enterprise operated behind the scenes. Bankman-Fried also owned Alameda Research, a private quantitative trading firm. He claimed Alameda was a normal customer on the exchange with no special privileges. The truth was hard-coded into the database. Engineers implemented an allow negative flag for Alameda. This bypassed risk engines, secretly exempting them from auto-liquidation. The bypass gave Alameda an unlimited $65 billion credit line, funded by billions drained from everyday FTX customers. Alameda masked a shortfall by using FTT, a token FTX invented, as collateral. They were borrowing real customer cash against a fabricated, illiquid asset that they controlled. The resulting $8 billion shortfall was the logical conclusion of these technical choices. The exchange's architecture was engineered from the beginning to facilitate the misappropriation of customer deposits. The collapse began on November 2, 2022. A leaked balance sheet revealed that Alameda's foundation consisted almost entirely of its own illiquid FTT tokens. 4 days later, Changpeng Zhao, the CEO of rival exchange Binance, triggered a sell-off by announcing he was liquidating his massive holdings of FTT. Market confidence evaporated instantly. Terrified customers rushed to pull their assets, attempting to withdraw $6 billion from the platform in 72 hours. The bank run proved that the exchange was insolvent. When customers asked for their money back, the missing $8 billion in deposits finally became a public reality. On November 11th, FTX filed for Chapter 11 bankruptcy, and Bankman-Fried resigned his position as CEO. The empire fell in 10 days because it was built on commingled funds and stolen deposits. Without the constant flow of new customer cash, the fabrication could no longer sustain itself. In December, authorities arrested Bankman-Fried at his luxury penthouse in the Bahamas and extradited him to the United States. Federal prosecutors in the Southern District of New York charged him with a litany of crimes, including wire fraud, securities fraud, and money laundering. His former inner circle, including Gary Wang and Carolyn Ellison, pleaded guilty and testified against him. They provided the evidence that Bankman-Fried personally directed the theft. After a month-long trial, the jury required less than 5 hours to reach a verdict. They found him guilty on all 7 counts of fraud and conspiracy. The judge sentenced him to 25 years in federal prison and ordered the forfeiture of over $11 billion in assets. Bankman-Fried leveraged the technical density of the crypto market and the social credit of public philanthropy to facilitate a multi-billion-dollar theft. He spent years building a facade of innovation to hide the commingling of billions in customer deposits.
Sam Bankman-Fried is serving 25 years. But how did so many smart people get fooled by a guy in cargo shorts who literally told them he thought ethics were a game? Subscribe. The next one is about another crypto fraud, and the person behind it hasn't been caught yet.